Welcome to this Click Explains video. This time I want to take on share incentive plans. Now some of you may have seen my separate video on save as you earn schemes. These share incentive plans are different. They work in a slightly different way. The principle's the same, but the mechanics are a little bit different. So try and distinguish the jargon and make sure you're clear on which one your employer's offering. So the background to these things would be what? Well, basically, share incentive plans are offered by a firm to its employees if they choose to do so. Not all firms offer them, but if yours does, well worth finding out about, and they come with their own twists. They create the chance for employees to become owners, so in principle, these are a good idea because they're offering an employee the chance to align their interests and their motivation, their incentive to work hard with the firm that employs them. But there are a few things to watch out for, and I'll come back to those in a moment. Now the basic mechanics of these things are what? Well, essentially, as I mentioned, this is a chance for employees to save money and use it to buy shares which are held in trust. And there are two ways that shares can accrue to you. We'll come back to those in just a moment. They do this via a number of routes, and the minimum holding period is 5 years. So essentially, you need to be thinking medium term at the very least in order to get the maximum tax benefit. This is not a scheme you can use as some kind of emergency cash point machine, if you like, whilst you're waiting for that minimum holding period to pass by. Now the options are what? So how do you actually get shares in one of these share incentive plans? Well, your employer can give you as an employee up to £3,600 of shares in a single tax year. They don't have to go for the full amount, but that is quite a decent amount if they choose to go close or up to the maximum, and it's annual. On top of that, an employee can buy up to £1,800 of shares, capped at 10% of their income per tax year. And on top of that, employers can choose to match shares bought by employees on a 2-for-1 basis. So well worth finding out what sort of terms your employer is offering this scheme on, because if they go up to the maximum benefit, potentially, this is, over 5 years, quite a sizable benefit you could be building up. Now, a few points to note as we go through this. So, employees buy shares using what's called salary sacrifice. Now that's great. So if you choose to go down the route of adding to your employer's contribution, if you like, you get effectively a gross benefit at a net cost. Salary sacrifice works in other areas too, but it basically means you've got a tax efficient way of buying these shares. And some schemes will allow employees to use any dividends they receive on the shares that are being bought on their behalf to buy up to £1,500 of further shares. So well worth digging into the rules just to find out, if you're enthusiastic, how much you could potentially contribute if you can afford to do so. And then here's a big benefit: there's no capital gains tax if the shares are held for the full 5 years that I mentioned earlier, but there will be income tax potentially on the market value of shares applied to early withdrawals. So the terms of these schemes are pretty generous and can be pretty generous, particularly if the share price of the company you work for rises while the shares are held in trust. But be careful about the dangers of early withdrawals. You really need to be thinking about committing to the plan. So, is this a nothing to lose situation? Well, the value of the account will fluctuate, obviously. Shares held on trust can go down as well as up. So you are basically locking in to the future of your employer. But remember, your employer's contribution doesn't really cost you anything. So it's the decision about whether you add to that, I guess, which ultimately you have to make on a personal basis. Shares can be sold capital gains tax free once this scheme matures after 5 years, or they can be kept, but they'll accrue CGT potentially from the maturity of the scheme, albeit the base price, as it's called, is the maturity price. So you sort of lock in, if the shares have gone up in value, a higher base price at the end of the scheme, and therefore a lower potential future capital gains tax bill. Now, a few other considerations. If you keep the shares on maturity, they may fall in value subsequently. So once the scheme matures, you have to think about whether you're going to sell, lock in some gains if you like, or keep them. And obviously at any point the shares can go down as well as up. Then, if you think about it, if you've taken advantage of the maximum contribution, your employer £3,600 per year, you £1,800 on top if you're allowed to, then you've reinvested dividends in the scheme, there is a risk of over-concentration, which means you could be overexposed to your employer's fortunes, and that's worth bearing in mind. Diversification on a personal asset level is important, and there is a risk of future capital gains tax complications. Now, having said that, there are some quite practical, sensible ways that you can reduce capital gains tax. And these include leaving shares inside the plan, leaving them on trust if you like, sending a proportion outside the scheme each year up to the capital gains tax annual allowance, which everybody gets every year, and it is use it or lose it, that allowance, and or transferring shares to a spouse, which will effectively double your annual capital gains tax allowance as a couple. So, in other words, don't let the capital gains tax tail entirely wag the dog. With some sensible advice and planning, there are ways to reduce CGT. Now, that's quite a short video on what is quite a big scheme. Quite a bit of detail left out. So any questions, in the first instance, editor@killick.com. And if you'd like to watch videos, including the one I mentioned on Save As You Earn schemes, plus another one on share option schemes, and all these schemes work in slightly different ways, then it's killick.com/learn.